Keisha has been doing the responsible thing. Every month for 3 years, she has transferred $300 from her checking account into her savings account at the big national bank she's used since college. She does not touch it. She does not think about it. She is proud of it. $11,000 sitting there being responsible, doing nothing spectacular, but doing something. Last Tuesday, she checked her savings account statement. The interest she earned in the past 12 months on $11,000? $43.12. She stared at that number for longer than she expected. $43 on $11,000 for a full year. That is less than the cost of a tank of gas, less than 2 trips to the grocery store, less than 1 month of her Netflix subscription. She called her bank, asked a customer service representative why the interest was so low. The representative told her the current APY on her account was 0.39%, said it was in line with the national average, said it with the calm confidence of someone who has given that answer 10,000 times. What the representative did not tell Keisha, what no one at the bank was going to volunteer, was what they were doing with her $11,000 while she was earning $43 a year on it. That is what this video is about. Here's something that sounds simple, but most people have never actually thought about all the way through. When you deposit money into a bank account, you are not storing your money at the bank the way you would store a box in a storage unit. You are lending your money to the bank. That is it. That is the actual transaction. You hand the bank your money, the bank gives you a promise to give it back when you ask, and in exchange for the use of your money, the bank pays you interest. The deposit is a loan. The bank is the borrower. You are the lender. And right now, in April 2026, the national average interest rate on a standard savings account at a major American bank is 0.39%. That is what the bank is paying you to borrow your money. Now, here is the question you need to sit with. What is your bank doing with your money after they borrow it from you at 0.39%? They are lending it out to other people at dramatically higher rates. The average credit card interest rate in America right now is 22.3%. Personal loans are running at 12 to 18%. Home equity loans are sitting around 8 to 10%. Car loans for buyers with average credit are at 9 to 13%. Your bank borrows from you at 0.39, lends to others at 8 to 22, keeps the difference. That difference is called the net interest margin, and it is the single most profitable business model in American financial history. J.P. Morgan Chase, the largest bank in the United States, generated net interest income of $25 billion in a single quarter in 2025. One quarter, $25 billion. The profit that comes from paying depositors less than 1% while charging borrowers 22%. Bank of America's net interest income rose nearly 10% in the same period. Wells Fargo posted a $5.4 billion profit in a single quarter and described credit quality as strong while raising its return targets. These are not secret numbers. They are in public earnings reports that banks release every quarter. The banks are not hiding what they do. They are just counting on the fact that most people will not put it together. Keisha put $43 in her pocket last year. Her bank put tens of billions of dollars in theirs, using her money to do it. Now, let me introduce you to Darnell. Darnell is 31. He keeps about $8,000 in his savings account at the same large national bank he opened an account with when he was in college. He does not think about it much. It is just there. Emergency money. Security. The thing his parents told him was responsible. What Darnell does not know is that he also has a credit card at the same bank. The balance on that card is $4,000. He's been carrying it for about 18 months, making the minimum payment every month, sometimes a little more when he can manage it. The interest rate on that card is 22.3%. So here is what is actually happening to Darnell financially. His bank is paying him approximately 0.39% on his $8,000 in savings. That is about $31 a year in interest earned. His bank is charging him 22.3% on his $4,000 credit card balance. At that rate, he is paying approximately $74 a month in interest alone, which means in a single month, his bank collects more interest from Darnell than it pays him in an entire year. Darnell is simultaneously a lender and a borrower at the same institution. He is lending the bank $8,000 at 0.39% while borrowing $4,000 from the same bank at 22.3%. He is paying 57 times more in interest than he is earning. This is not a coincidence. It is not an oversight. Banks design their product ecosystems specifically so that this happens. They want you keeping your savings with them and carrying your debt with them simultaneously. The math works perfectly in their favor. And Darnell is not unusual. According to the latest Federal Reserve data, Americans are carrying a total of $1.3 trillion in credit card debt as of early 2026, the highest level ever recorded in history. That same group of Americans has tens of billions of dollars sitting in savings accounts, earning fractions of a percent at the very banks charging them 22% on their cards. The bank profits from both sides of that equation. The depositor and the debtor are often the same person. In many cases, they are Darnell. Here is where it gets worse. Most Americans do not know that there is an alternative that has been available to them for years that pays dramatically more than a standard savings account. It is called a high-yield savings account, and as of this week in April 2026, the best rates on high-yield savings accounts are sitting at approximately 4 to 4.21% annual percentage yield, offered by online banks that are fully FDIC insured, meaning your money is protected up to $250,000, exactly as it would be at any major bank branch. Let me show you what that difference means for Keisha. Keisha has $11,000 in savings. At her current bank earning 0.39%, she made $43 last year. If Keisha moved that same $11,000 to a high-yield savings account earning 4%, she would earn $440 in a year. Same money, same risk level, same FDIC insurance protection, 10 times more interest. The difference between where most Americans keep their savings and where they could keep them is costing the average middle-class household hundreds of dollars every single year, not because of bad investment decisions, not because of risky moves, simply because of which savings account they chose to open, or more accurately, simply because they have never been told there was a better option. Now let me be honest about something, because this is a finance channel and honesty matters. High-yield savings account rates change. They are not fixed. The 4% available today reflects the current interest rate environment after the Federal Reserve cut rates 3 times in late 2025. Rates have been coming down from their peak. If the Fed continues cutting rates in 2026, the high-yield savings rates will likely follow. But even at lower rates, the gap between a standard savings account at a major bank and a high-yield account on an online bank remains significant. The national average savings rate right now is 0.39%. The best high-yield accounts are at 4%. The difference is not a rounding error. It is a factor of 10. There is one more thing I want to show you because it is the part that changed how I think about banking entirely. Remember Darnell. 8,000 in savings, earning 0.39%, 4,000 in credit card debt at 22.3%. Most people in Darnell's situation think about these two accounts separately. The savings is savings, the debt is debt. You manage them independently. But here is what the math actually says. Darnell's $4,000 credit card balance at 22.3% costs him approximately $892 a year in interest if he carries it for the full year. The interest his $8,000 savings earns him is approximately $31 a year. The net cost to Darnell of this arrangement, the credit card interest minus the savings interest, is $861 every year. Now here's the question. What if Darnell took $4,000 out of his savings account, leaving himself with a $4,000 emergency fund, and paid off his credit card entirely? He would save $892 in annual interest on the card. He would lose about $15 in annual interest on the $4,000 he moved out of savings. The net benefit of that single decision is approximately $877 per year. That is not a small number. That is a car payment. That is 2 months of groceries. That is the kind of money that changes what a monthly budget feels like. Most people never make that calculation because they've been taught to think of savings and debt as separate conversations. Banks benefit from that separation. They collect 22.3% from Darnell's left hand while paying 0.39% to his right hand, and no one asks them why both transactions happen to run through the same institution at rates that are 57 to 1 in the bank's favor. So here is what I want you to actually do with this information. 3 things that can shift real money back in your direction starting this week. The first thing is check your savings account rate right now. Pull up your banking app, find your savings account, look for the APY or interest rate. If it is under 1%, and for most people at major banks it will be well under 1%, you are leaving money on the table every single month. The second thing is look up what a high-yield savings account is currently offering. Search high-yield savings account on any financial comparison site. Look for FDIC insured accounts with no monthly fees and no minimum balance requirements. The best accounts right now are offering around 4%. The difference between 0.39% and 4% on even a modest savings balance is hundreds of dollars a year that is currently going to the bank instead of to you. Moving your savings is not complicated. It takes about 15 minutes online. The money remains fully protected by FDIC insurance. The only thing that changes is who benefits from your savings, you or your bank. The third thing is do Darnell's math. If you have both savings and credit card debt at the same bank or at any banks, run the actual numbers. What is your credit card interest rate? What is your savings account rate? What is the real cost of carrying debt while simultaneously holding savings that earn almost nothing? For many people making this calculation for the first time, the answer is genuinely surprising, and surprising in a way that makes the path forward much clearer than it was before. Your bank is not your financial partner. It is a business. It profits from the spread between what it pays you and what it charges you. Understanding that is not cynical. It is just accurate. And accurate information is the only thing that actually changes outcomes. Keisha moved her $11,000 to a high-yield savings account the week after she saw that $43 interest statement. She will earn more than $400 this year on the same money. The bank did not call to tell her she was leaving a better option on the table. They never do. New videos every Tuesday and Friday. My name is Claire, this is Claire Audits, and I will see you in the next one.